Between June 4th and June 6th, 2026, over 340,000 cryptocurrency traders watched their financial lives vanish in real time. It didn't happen because of a massive hack, a regulatory ban, or a sudden economic collapse. Instead, a silent mathematical trapdoor triggered inside the smart contracts of major exchanges, turning $3 billion of paper wealth into absolute zero. This is not a story of bad luck. It is the anatomy of a mechanical loop designed to hunt you down. To understand how this trap was set, we have to look at the illusion of safety that built up during late May. Bitcoin had been comfortably consolidating around the $67,000 mark. Retail investors were complacent, convinced that the worst of the macro volatility was behind them. On social media, the consensus was clear. A breakout toward new all-time highs was inevitable. But beneath this calm surface, a dangerous structural imbalance was forming. Retail traders, driven by the fear of missing out, began stacking massive amounts of leverage. They weren't just buying Bitcoin, they were borrowing money from exchanges to buy more, pushing open interest, the total value of outstanding derivative contracts, to dangerous, historical highs. Exchanges love this. Every leveraged position requires collateral, usually held in the form of crypto itself. But leverage is a double-edged sword. If you use 20x leverage, a mere 5% move against your position means your collateral is entirely wiped out. What retail traders forgot is that the market makers and algorithmic trading bots know exactly where these breaking points lie. They are called liquidation clusters, dense pockets of automated sell orders waiting to be triggered like landmines. All the market needed was a single spark. The spark arrived on the morning of June 4th, 2026, from the traditional financial sector. A hotter-than-expected U.S. employment report hit the wires, signaling to institutional investors that the Federal Reserve would likely keep interest rates higher for longer. In seconds, macro-risk asset managers began de-risking. The Nasdaq Composite Index plunged 5% in a matter of hours. In the crypto markets, the reaction was immediate but initially controlled. Institutional capital began moving out. The spot Bitcoin ETFs, which had enjoyed weeks of positive inflows, experienced a sudden reversal. This marked day one of what would become a historic 13-day consecutive streak of capital flight, eventually bleeding out $4.33 billion from the spot markets. Bitcoin slipped from $67,000 to $64,500. As spot prices fell, the pressure shifted entirely to the derivatives market. This is where the mechanics of modern crypto infrastructure become lethal. When a trader's margin drops below a specific threshold, the exchange doesn't call them on the phone to ask for more money. An automated smart contract instantly seizes their collateral and market sells it to protect the exchange's own capital. By midnight on June 4th, Bitcoin touched $63,000. The first layer of over-leveraged long positions, mostly retail traders using 50x to 100x leverage, shattered. This forced selling flooded the order books with more supply than the market could absorb, pushing the price down further, which immediately triggered the next layer of liquidations at $62,000. This is the exact moment where human emotion was completely removed from the equation, and the machine took over. This is what insiders call a liquidation cascade. Most mainstream media outlets during these 48 hours blamed the crash on a bizarre rumor, a leaked report claiming that MicroStrategy, now known as Strategy, had sold 32 bitcoins to pay out preferred dividends. But think about it logically. Strategy holds over 845,000 bitcoin. The sale of 32 bitcoins is a drop in the ocean. It cannot move a multi-billion-dollar market. The rumor was a symptom, not the cause. The real crisis was structural. On-chain data revealed that the funding rates, the fees long traders pay to short traders, had turned deeply negative. The market makers were no longer stepping in to buy the dip. They were stepping back, letting the automated cascade run its course so they could buy Bitcoin at a steep discount lower down. On June 6th, the cascade reached its terrifying climax. Bitcoin breached the psychological support of $60,000. What followed was absolute chaos. As the price breached $59,500, a massive cluster of long positions on major exchanges like Binance, OKX, and Bybit was hit simultaneously. The exchanges' matching engines were overwhelmed. The sheer volume of automated market sell orders caused slippage, meaning traders were liquidated at prices much worse than their stop losses. In less than 2 hours, Bitcoin bottomed out at $59,100. Over 85% of all liquidations recorded during this 48-hour window were long positions. The Fear and Greed Index, which had been flashing greed just a week prior, collapsed to a reading of 12, extreme fear. The system had successfully purged the leverage, leaving hundreds of thousands of accounts completely empty. Then, just as suddenly as the destruction began, the bleeding stopped. The moment the liquidation clusters were completely cleared out at $59,100, the automated selling pressure vanished. The order books were empty of sellers. Smart money, institutional market makers, and whales who had been sitting on the sidelines with billions in stablecoins stepped in. They didn't buy because they felt bad for retail. They bought because Bitcoin was mechanically oversold. What followed was a violent relief rally. In a staggering display of volatility, the price of Bitcoin snapped back from $59,100, tearing through resistance levels to stabilize back into the $63,500 to $65,500 range within a day. The market looked almost identical to how it looked 48 hours prior. The price had recovered, the charts looked stable again, and the commentators on social media returned to predicting the next bull run. But the landscape was fundamentally altered. $3 billion had been transferred from the pockets of over-leveraged retail traders directly into the balance sheets of disciplined market makers. The traders were gone. The money was gone. The machine had reset. This devastating 48-hour cycle exposes a fundamental truth about the crypto architecture that most retail investors ignore. The market does not care about your bullish thesis, the technology of your favorite project, or what the macro outlook looks like over the next year. In the short term, crypto is governed entirely by the harsh physics of liquidity and leverage. The biggest mistake made by the 340,000 traders who lost everything wasn't being wrong about Bitcoin's long-term value. Their mistake was leaving themselves vulnerable to the exchange's automated liquidation mechanisms. When you trade with high leverage, or worse, when you leave your long-term assets on an exchange to use as margin or collateral for quick trades, you are essentially giving the system permission to take your wealth when volatility spikes. As we move deeper into 2026, these liquidation cascades will become faster and more violent. With institutional algorithms and automated smart contracts dominating the volume, the market will continue to engineer these artificial liquidity crises to flush out impatient capital. To survive this environment, your strategy must evolve. You cannot play the game by the rules of the house and expect to win. What do you think was the biggest warning sign that traders missed before this crash? Let me know your thoughts in the comments below. And don't forget to like and subscribe for more deep dive market documentaries.